Good morning and welcome everyone to the Moneycontrol live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. Well, Dhanteras greetings and Diwali festivities to all the viewers out there and their families. Let's start off with the market. Indian equity markets likely to start a bit weak as Fed fears resurfaces. S&P and 500, S&P 500 and Nasdaq has snapped an 8-day winning streak after higher bond yields spur sell-off. Treasury yields jumped after poor results of a 30-year bond auction and hawkish comments from Jerome Powell. Powell's caution on interest rates drive Asian markets lower. The comments like if it becomes appropriate to tighten policy further, we will not hesitate to do so. Perhaps has not gone down well with the street, which has led to some amount of profit booking coming in. In terms of FII, offloaded shares worth around 1,712 crore and DIIs have bought equities to an extent of 1,512 odd crore. Earnings that need to be watched out for. Well, you have the likes of ONGC, Mahindra and Mahindra, Coal India, Hindalco, Eicher Motors, Life Insurance Corporation of India, Biocon, Glenmark Pharma, Hindustan Aeronautics, Rashtriya Chemical and Fertilizers, Tata Chemicals. These are going to be some of the companies which will be announcing in their September quarter earnings. What we have in terms of the F&O space, well, FIIs continue to be the net sellers in index futures as well as index options along with stock futures. The trend is no different for Bank Nifty futures and Bank Nifty options. Across the board, they've been selling. What remains in F&O ban, what still remains in the ban is GNFC, Delta Corp. What's new in the ban is Chambal Fertilizers and MCX. Option Qs there, sentimental indicator Nifty PCR now at 0.99, which is well above that one level versus 0.98. But let's discuss the trade setup strategies for the day along with Brijesh Ail, who heads the technical and derivative retail research for IDBI Capital Markets and Securities Limited. Hello there. First festive greetings, of course, the Shera and Diwali greetings there to you. Beg your pardon, the Dhanteras greetings there for you. I'm going to start off by asking you about your strategy for the markets. What do you make out of it? The levels that one could watch out for, and of course, few nuggets for this festivity for our viewers out there.
Yeah, morning, Nickey. So, and happy Diwali to the viewers and all of you. So, I think somewhere the market is positive. We are seeing a sideways consolidation for the last couple of days. But then, having said this, the way the market moved about this 19,300 level, it has turned into a slightly into positive territory. Now, having said this, the level of this 50-day moving average, which is somewhere near to 19,560, is acting as a resistance zone. So maybe today, tomorrow, yeah, maybe the next week, I think this level is about to take out. And we are of the opinion that market should be in the range of 19,300 to 19,800. This is the immediate range for the Nifty. And this today's decline also, I believe this can be one of the buying opportunity with the stock-specific trades. So the bias is quite strong positive as far as Nifty is concerned. And if you look at the bank index, so bank index is one which is seeing a good amount of long build-up. 43,500 was the trigger for in the last couple of days when it moved above those levels. So I think Bank Nifty is poised for 45,000. If Bank Nifty rallies to 45,000, then I think even the Nifty will see a move towards 19,800. So definitely the structure is turning bullish, and data may be slightly seeing some amount of consolidation, but bias is positive. 19,300 remains the base for the Nifty, and 43,500 I think is likely to be the support for the Bank Nifty as well.
Right, most of the people prefer buying gold, on Dhanteras, but do you have any themes per se which could be, probably something in the likes of Titan or other jewelry makers perhaps that they could look into if they were supposed to buy in the equities? Top 2 recommendations coming in from you.
So basically, we were extremely positive on the Kalyan Jewelers. So that Titan and Kalyan Jewelers are the two picks. I think probably Kalyan has already moved up. So I think some corrections we need to keep a watch on. But then even from the long-term perspective, there can be opportunity in the Titan and the Kalyan Jewelers as well. So I think this should be the two space which we need to keep a watch on.
All right, so clearly those two space that we need to watch out for. Apart from that, any other recommendation that you have for our viewers, Brijesh?
Yeah, I think for the day yesterday, as we all know that M&M, there was a very good breakout was seen in the M&M. I think M&M is likely to see some very strong bounce from the current level. So this there has been a volume breakout. I have a trade setup with the M&M at the current price, and the stop loss would be 1537, and I would be looking to 1590 as a trading opportunity in the M&M counter. Next is on the City Union Bank. City Union Bank for the very first time has crossed 140 levels on the weekly time frame, which is very bullish. I think immediately we should be talking of another 20-25 points on the City Union Bank. That's a short term view. Trading opportunity can be a 5 to 10 points can be a trading opportunity. City Union Bank is extremely positive. I think the traders can take City Union Bank at current price with a stop loss of 140. The target would be 153. Next one was the FDC, which has again seen a very good breakout in yesterday's session. I think with the current price, one can take a long entry. The 380 would be the stop loss for the target of 405. So this would be the more of a trading bet for the next 1 or 2 trading session.
All right. These are some of the stocks that, of course, we're going to be looking at. But also what needs to be on your watch list for the day includes the like of ESAF Small Finance Bank. Of course, it's going to be debuting in today on exchanges on November 10th. The final issue price has been fixed at around 60 per share. The date of allotment of shares is around November. It's today, so that's going to be the one that you're going to be looking out for. Good set of, if you look at the subscription data, well, the issue was subscribed well. It's a small finance bank that we're talking about. Of course, Zee Entertainment also has come in with numbers where the revenue is up by 20% and the EBITDA too has shot up by 5.6%, a flat growth thereabouts, decent number. Margins have come in at 13.6% versus 15.6%, a bit of margin contraction there. But overall, the net profitability of the company is also up by 9%. That's Zee Entertainment for you. Apart from that, BEML. Good set of numbers reported by the company. Revenue is shot up by 14% and the operational performance too is up by 47%. That could be the one interesting one to be watched out for. Margins at 6.7% versus 5.2%. But let's address the market open there for you. Well, it is a good occasion, but the market and the risk sentiment seems to be a bit of weak at this point of time. We are looking at losses coming in for equity markets to an extent of 0.25% rather, 19,350, way below that level, or let's just say closer to that level of 19,350 mark. Also, let's talk about Bank Nifty. How is that shaping up for you? Just to see if you're looking at some amount of weakness coming in, even for Bank Nifty. Apart from that, let's also talk about other sectoral indices, something in the like of mid-cap index and the small-cap index. That also is one that we need to watch out for. A bit of weakness coming in for banks, mid-cap index, small-cap index aren't really doing too well either. A flat start coming in for small-cap index too. IT is a little down and out. PSU Bank, those are the interesting bets that you need to watch out for. Pharma is also not doing too well. Selling pressure is taken across the board. Well, PSU Bank, metal counters, well, PSU Bank's amount of selling pressure is completely coming in the morning. Metal is acting no different. Let's talk about the top gainers and the top losers that we have overall on the list, just to see where the momentum has been stacking up for you. Well, Adani Enterprises, Power Grid and Adani Ports. These are some of the top gainers that we have. Coal India and ONGC, some of the other top gainers. Apart from that, top losers. Let's also look at the list of top losers. We're looking at advances, which are 38, 11, and declines, which is 38. M&M, Titan and IndusInd Bank. These are some of the top losers. DRL and Eicher Motors along with UPL. These are some of the other top losers that we have. So Titan is the one which has witnessed some amount of selling pressure in early deals along with M&M. Brijesh, would you want to come in on those two bets that you're talking about? A bit of selling pressure accentuating for Titan, one of the top losers on Dhanteras. And apart from that, also for the markets, were you anticipating this week close around that, below that 19,350 mark? What's the next level here on?
So Miki, the view for the M&M, I would be quite positive. So this is a buying opportunity. Yesterday there was a very strong bullish candle. So this decline close to 1540, 1530 is a very good opportunity to make a re-entry point. So no change in view. One should hold a long position in the M&M. I think that's a trading bet. 1600 should be on cards. Coming to Titan again, I believe this last 2 days of correction is a very good opportunity. If you see the Titan daily chart, the buying was seen on the 3rd November, and the low for that particular day candle was 3,228. So I'm not saying we are going to see 3,228 levels, but then definitely this 1% correction on the Titan is a very good opportunity. The maximum risk one has to take is 30 to 30 levels. I think this correction should be viewed as a buying opportunity for the Titan as well.
All right, Brijesh, we're just going to leave it at that. And thank you for taking out the time and speaking to us this morning.
Thank you.
Right, the other guest that we have clearly on our Friday special and also Dhanteras special show, opening bell show, is Pankaj Tibrewal, who is the Senior Executive Vice President and Fund Manager at Kotak Mahindra AMC. Well, festive greetings there. Happy Dhanteras. Let's start off by asking you, what are you buying today? Is it equity or gold for that matter?
Good morning and wish you and your viewers a very happy Dhanteras and a very happy Diwali in advance. Obviously, I'm an equity person all in, all out. So our heart lies with Indian equities, and we believe it's a great time from a next decade perspective that Indian economy is in a very solid position, and probably market should follow the suit. But in the near term, we need to be a little careful from a broader market perspective, and we can expand as we go along.
Sure. Pankaj, I just want to ask how to play Indian markets ahead of Mahindra trading session. I'm sure you don't really typically talk about stock specific, but just as an exception, maybe you'd want to talk about few themes and the leaders that we could look into, at least on the day of Mahindra trading. And of course, gold jewelry stocks like Titan today have not been doing too well. We are going to get on to the broader discussion and take an aerial view of what's going to be next for somewhat 2080. But just a preliminary assessment of this first.
Yeah, so obviously, short term, it's always difficult to call a day or two. But if you slightly take a pause and look forward from a medium term perspective, few of the themes which we believe are very powerful themes as you move ahead. One is the manufacturing. I think with whatever is happening geopolitically around us in the globe, I think countries will become more and more inward, and they would like to outsource or diversify their supply chain base out of China. And I think India is in a very, very solid position. The more and more companies and managements we speak to, both local and global, I think India is finding the flavor. Unless we make a self-go, I think next 5-10 years for manufacturing sector looks very, very strong, both from a demand substitution perspective in India and from an export perspective outside India. And all the major global companies are now talking about having a large presence in India. And I think manufacturing is clearly looking good across capital goods, across chemicals, across auto ancillary. The entire manufacturing gamut is looking very, very good. The second, in the near term, I think one sector which has surprised for the last 2 quarters is pharma. And we continue to have a positive stance on that. We believe the last 4-5 years was not great for pharma. And incrementally consolidation, which has happened in US, is now leading to some kind of a pricing discipline among most of the generic players, which bodes well for companies which have both domestic and overseas presence. The third sector, probably from a valuation perspective, looks to be banking, private sector banks especially. This year, calendar year to date, Nifty is up 7%. Mid and small cap index is up about 25 to 30%. And if you look at the BankX, it's just up 1%. So I think there is a very large opportunity where most of the private sector banks are trading at very reasonable valuations. So I think that's another one which is looking quite good. Last but not the least, I think consumption has been a laggard for the last couple of years. The festive commentary by most of the corporates, both on discretionary as well as to a certain extent consumer staple, suggests that the worst may be behind. There's some uptick on consumption from a festivity perspective, and second half promises to be much better than the first half or maybe last almost 7-8 quarters. So we believe that selectively consumer discretionary pockets are also looking good. So these will be some of the themes where we would be positive
Sure.
on from a portfolio perspective.
Sure. Pankaj, when shopping for mid cap and small caps, do you go at the bottom of the barrel or prefer sticking with the creamy layer, the highest cap stocks amongst the small cap or mid cap category? What kind of stress test do you run in your portfolio to pick the stocks that you do?
So first, I think there's a myth that mid and small caps mean smaller or smaller companies. Yes, they may be mid and small cap classified because of market cap. But when we did an exercise from 101, which is the cutoff for a mid cap, from starting point of a mid cap to the next 500 companies, you'll be surprised to know that more than 200 companies are leaders of the sectors they operate in. So it may be a mid cap in a tile sector, for example, but it's the leader of the sector, number one or number two player. It may be a small cap in a plywood or a wood panel company, but it will be a leader in the sector it operates in. So I think there's a myth that mid cap, small cap means only the smaller size companies, but our assessment over last so many years suggests that there are leaders in this segment, and if you pick and choose the right leaders of the sector, and our preference always lies for that, probably you could see them growing over a period of time and as they gain market share. Some of the things which I believe that one should not make mistakes while picking small and mid caps is the fact that one, keep clearly that in your mind, that the fact in your mind that the mortality rate in mid and small caps are quite high. Only 13% of the small caps have been able to move into mid or large caps over the last 20 years. So you need to be careful while selection. And few of the filters which we use is first, the pedigree of the promoters. I think the DNA of management promoters plays a very important role in the success of companies becoming small to large. And we do a lot of, on-ground research, try to find out about the lifestyle of the promoters, the intent, and going back into the past history. The second one, which is financials, is people always get carried away by the momentum of profit and loss. We believe balance sheet and cash flow are most important. So top line is vanity, bottom line is sanity, but cash in bank is reality for us. And the moment you start analyzing companies on balance sheets and cash flows rather than only P&L, yes, growth is important, but not at the cost of balance sheet and cash flows. That's the second most important filter. And the third most important filter is the capital allocation, that if you are investing 100 rupees in the business, can the business generate 15, 20 rupees minimum to help you grow over a period of time without depending on external capital, which is debt or equity. And the companies who have been able to successfully do that have actually become multi-baggers over a period of time. So if you do 4 or 5 good checks and make sure that there is longevity in the business, the managements are thinking about optionalities after every few years into the business, thinking about long-term, I think, and you are patient enough with those names, I think over a period of time, probably you have winners in your portfolio. And don't forget one thing, like in life and investing, what not to do is more important than what to do. If you have a list of companies where you will not invest based on certain other filters, the list where to invest will become smaller and you can focus on more and probably get winners out of that.
Point well taken. You think Hrithik would come back in summer 2080, that is HDFC, RIL, Infosys, TCS, HUL and IndusInd Bank along with Kotak Mahindra Bank, of course. This is a theme which the market is talking apparently will make a big comeback in summer 2080 because the leaders of the large cap category were, they were underperformers for the last 2 years or so. Do you think this time, this summer, this trend will turn around and Hrithik probably will come back?
Don't know whether Hrithik will come back or Salman is doing well. These are acronyms. But one thing which is very clear is that in this market today, large caps have become quite reasonable. If you look at over the last 18 months or so, actually large caps P's have derated. Earnings growth have come in, but when you look at the P has actually contracted. And almost in our calculation, about 50% of the indices in Nifty have not participated the move from 16,000 to 19,500. And these are some of the quality franchises which are part of Nifty. So we believe that large caps today on an overall relative basis looks much attractive compared to mid and small caps. On the mid and small cap broader markets, I think that this category is rewarding. And if you look at the last 20 years, probably this category looks to be very, very good from a return perspective. But one needs to have a clearly cautious view at the moment because greed is clearly visible on the street. And a couple of data points which we would like to talk about. The first one is the data point on market cap distribution. If you look at the mid and small cap cohort today, as a percentage of overall market cap, it's now about 35%, and large caps are 65%. But when you look at the profit distribution, large cap, the top 100 companies of India constitute about 75%, and mid and small cap constitute about 25% of the profit pool. So there's a disconnect between the large caps, market cap distribution and profit distribution, and mid and small cap market cap distribution and profit distribution. Please keep that in mind. The second one is the earnings yield, which is nothing but 1 by P. And if you look at the earnings yield today, there is virtually no difference on the profitable companies between mid, small, and large. All of the earnings yield of all the three indices or the three categories are virtually the same. So for the extra risk which you take in mid and small cap, if you're getting at the same earnings yield of large cap, why not look at large cap? And third, if you look at the flows have been very strong in mid and small cap funds, and the free float has not expanded to that extent. So there has been a scarcity premium, whereas flows have chased a lot of companies, and probably that's the kind of momentum you see in the market. But this is the time to reassess risk in the portfolio. This is the time to adjust your beta in the portfolio. And probably, if any weak companies with broken balance sheets, broken cash flows, probably needs to be adjusted from a portfolio perspective. So I think this is the time for assessing your risk in the portfolio. And probably our sense is 2024 could be a year for large caps rather than the broader market.
All right. Pankaj, since you spoke about large caps and probably the preference towards that, you think you would want at this point of time prefer old economy stocks over new age stocks? In fact, incremental mutual funds now have started taking shining to the new age stocks like Paytm, Nykaa, Delivery, amongst others. The matter for that matter also, for a matter of fact, has returned to the 1 crore club. How do you look at it? Old economy versus new age? How your bifurcation would be in terms of asset allocation if one was to look at it between the two of them?
So I think obviously many companies who are exposed to the digital and in different parts of the business, we believe that there's a long runway for growth. However, I think post-listing, most of them, the mistakes they made have probably been recorrected. And I think it's good that in the starting point of your, market debut, you have learned from those mistakes. I think most of the companies spoke about that they may not make profit or cash flows in the near term to medium term. I think they have course-corrected themselves. Some of the companies have come back to operational profits, which markets have given a thumbs up to. So I think from a long runway of growth, they have the right ingredients. They have the right to win. The unit economics is good. Cash flows have started to support. So we will be very selective in our selection of new age companies, but there seems to be a lot of promise in some of them. And probably we are, approaching a few of them with an open mind. Few of them are part of our portfolio as well.
Which are these the ones that are part of your portfolio in that case?
Yes, obviously. So I think we are positive on the food delivery space. We believe that has a long runway for growth. And obviously, it's very closely linked to India's consumption. It's a market with almost 2 or 3 players only. So the market leadership is well defined. The unit economics is well defined. And I think capital allocation, few of the players made mistakes and they are now self-correcting it. So we seem to be having a positive bias towards them. And we are evaluating every time any new age company comes through. We obviously look it through in greater details. And that's one space over the next 5-10 years where we could find new winners from a market cap perspective.
All right. Which themes for the year has been overplayed? Of course, you spoke about being bullish on manufacturing. So I'm just going to move out the electronic manufacturing stocks out there. The EMS theme too has been a bit of a hot theme this year. Apart from that, defense and banks. Which of these two now you think have been overplayed and the valuations look a little bit stretched?
So banking, clearly the private sector banks have underperformed actually. So they have not been overplayed. And I think over a period of time, I think banking sector will grow if the economy has to grow. And valuations have reasonable, I won't say mouth-watering, but reasonable in certain extent when you look at in relation to their long-term averages. The other point which I wanted to derive is that what one should be watchful about is the low free float stocks. I think there has been a huge run up in some of the lower quality names, low free float stocks, where float is only 2, 3, 4, 5%, but market cap, run up has been more than 2x, 3x, 4x. I think one needs to be a little careful there, making sure that you don't make mistakes in this kind of a momentum market, because the mistakes which you will make today probably will hurt your portfolio over the next 2 years. So one needs to have a clearly careful.
Sorry to interrupt you here. Your audio seems to be a bit of a little bit patchy at this point of time. Could you speak up a little higher at this point?
Yeah.
Because the audio is a bit of an issue right now.
Can you hear me now?
Yes, it's better.
Yeah. So what I was saying that what one should avoid is the low free float, low quality names, which have seen a very sharp run up over the last 12 months or so. Stocks have multiplied. But when you look at the free float, 2%, 5%, 8%, I think one needs to be a little careful because the businesses may not support or earnings may not support the kind of valuations they are, trading at. Apart from that, I think banking has underperformed, except PSU banks and NBFCs for sure. I think private sector banks have clearly underperformed in this rally over the last 12 months or so. And there seems to be opportunity brewing out there where valuations are very cheap in relation to long-term averages.
All right, Pankaj, any last theme that you'd want to talk about that you're really bullish at this point of time in the run-up to the new year?
So I believe that the themes which I spoke about are medium to long-term themes.
How about stockbroking stocks, which have been on a roll for a while because of the incremental growth that we've seen, plethora of IPOs that have come in, good run of equities thus far. Do you see more amount of momentum continuing there?
So if you look at phones since COVID, there has been a structural change. Till COVID, we were at 3 crore demat account. From 2020 to 2023, we have multiplied it 4 times to 12 crore demat account. And when you look at the universe is about 50 crore PAN holders. And that's virtually your universe because anybody who has a PAN card probably can be a equity investor at some point of time. So I think from companies who have evolved themselves from a digital perspective, who are looking at this space very differently, probably could be the winners as you move ahead. But just some caveats that this is a cyclical business. One needs to be careful that you are at the cyclical high point in the markets today. And your fortunes are dependent on what the underlying market does. So be careful on that side. And second is, when you look at a lot of brokerages today, a large part of the revenues are derived from futures and options. In some cases, 80-90% of your profits as well as your top line are derived from the trading business, not the cash delivery business. And if markets, at some point of time correct, the volumes also kind of evaporates very fast, and that has the bearing on your overall business. So I think you need to buy these businesses extremely cheap and wait for the cyclicality to play out.
All right, Pankaj, some fund houses are also now attempting passive funds in mid-cap and small-cap space. Do you think that would work? Large distributors openly say that they don't invest in mid-cap and small-cap space. The investors, do you think, can afford to invest into these?
So let me give you a data point. So if you look at the last 15 years, 2008 to 2023 as we speak today, there have been 3 years where in large portion of mid and small cap funds have underperformed the indices. One was 2007-8, the great bull market, which we saw. Then was 2017. Again, we saw huge rally in mid and small caps, and 2023. These are the 3 points where the active managers, a large portion of them, above 80% of the active funds, have underperformed the mid and small cap, indices. But apart from these 3 years, if you look at broadly the last other 13 years, large portion of active managers have been able to create alpha over the mid and small cap indices. So we believe that the space is all about avoiding mistakes, making sure that you don't invest in broken balance sheet cash flows, crooked promoters, and so on and so forth. Whereas in the mid and small cap indices, they will not make a differentiation. I believe that the space is well, participated with active managers. And I think over the period of time, active managers have shown that this space, they have been able to generate alpha. So I would be an advocate in this space that go for a good active managers who can protect your downside during drawdowns and then participate in the upside. And we believe that if over a period of time, you can protect the capital of the investors during the drawdown phase, automatically upside will come because you will be staying on the pitch for a longer period of time. You don't need to hit every ball for a 4 or a 6. In this space, you need to be staying on the pitch for a longer time. Trust me, runs will follow.
Yeah, I'm pretty pro-active fund case scenario also, but given the returns that we've seen from some of the fund houses in terms of active category, passive seems like a better option, but we're going to completely running out of time, so we're going to leave it at that. And thank you for taking out the time and speaking to us this morning. And of course, wishing you again and happy Dhanteras to you and your family.
Thank you so much, and wish you and all your viewers a very, very happy Diwali and Dhanteras.
All right. Thank you so much. Well, with this, it's a wrap and goodbye from the entire team who puts this piece together. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen. And for rest of the days, stay tuned into moneycontrol.com and Moneycontrol app.
We have the best Diwali party in town. Stocks, songs, patakas with some of the most admired investors on the Lal Street.
Diwali is not just about lights, it's also about illuminating your financial future. So join me in our exclusive Diwali stock market extravaganza.
We'll dissect the market trends, unwrap hidden opportunities, and light up your portfolio with expert insights.
In the spirit of Diwali, come discover some hidden gems that can light up your investment journey.
From Diwali picks to strategic play, we've got you all covered. Don't miss out on the financial fireworks.
You don't want to miss it. See you on November 10th, 4:30 p.m.